with setting up these virtual conferences. So we're really thankful to them for their help with that. And we're going to move right along. We're running about 4 minutes behind today so far. Larry, you want to get us started with the 5 bright spots that we can talk about today in the self-storage market?
Sure. Thanks, Shelley, and thanks for the invitation this morning to give everybody an update on what what's going on in the marketplace. Today, what I'd like to do is kind of touch on some themes that I'm seeing. So, am I on the speaker mode?
I believe so. Yeah.
I need to enlarge my screen.
Yeah, and if the vendors, if you guys want to jump over
speaker
to
view.
your
it.
vendor hall, you can do that.
Okay. So the intent today is next month will be my 22nd year in the industry. I was a commercial real estate broker, working with mostly office properties, 25 years ago, and was recruited to represent Argus in this part of the country back in 1998. And I thought I'd share my perspective. I've been through a few cycles and share my perspective on this particular crisis and some of the things that have been going on. I've been an owner for 17 years of a 700-unit facility. I put an investment group together and we bought a 700-unit facility in Kansas City, Kansas. So I'll get into operations a little bit and some of the trends that I'm seeing, that are accelerating. But generally, my comments today are really pretty upbeat, and what we're seeing are very positive, and it offsets a lot of the negativity we're seeing, like with the the long-term consequences of this crisis. Increased public and private debt, the high unemployment that that's going to be with us a while. Of course, the ongoing public health concerns, and I'm a little pessimistic about just the overall effects of the consolidation from small business to larger organizations. So hopefully you'll find my my thoughts upbeat if I can figure out how to load them. Okay.
We can see your screen now, Larry.
Okay. So I would venture to say right now, for those that, it's an environment that's tough to plan, but I would say, at least in the short term and intermediate term, with low cost of capital, transaction velocity may be stronger than ever, at least in the Mid-South and Midwest, the areas that I'm working. And my focus is Kansas, Missouri, Arkansas, and downstate Illinois. Arkansas was a particularly lively state in 2019 for transactions. I was fortunate to be involved with a bunch of transactions in 2019. I thought it was just me, but actually relative to Missouri and even Kansas, there was quite a bit of transactions, and generally the transactions, were given the low cost of capital. There were some, properties were trading at robust prices. The general environment that I'm working in, buyers are focused on the post-virus environment. We don't know when that's going to be, but there's the enthusiasm is stronger than ever. There's lots of different sources for financing right now. There's a few that are out of the game, such as commercial mortgage-backed securities, fixed-rate vehicles such as CMBS and life insurance loans. But bank loans are robust, and the industry has proven itself to be very robust, as most of us know. And this graph that I have up on the screen, let me minimize so I can see it. It just shows the there we go. How these statistics are coming from the National Association of Real Estate Investment Trusts, so it's going to be more on an institutional will have more of an institutional skew. But you'll see how self-storage in 2019 was starting to gain favor, insofar as like trading at higher prices. The fundamental performance has been strong, so total returns, are up. And that's been a trend that's been going on for a while. But, now with this crisis, I think that's going to accelerate as, obviously retail has been hit hard. Office is an unknown, and industrial strong, but just for the need of distribution space. But self-storage has been, to say resilient, it's almost an understatement. Some things around. I can't say cap rates I haven't seen cap rates go down, and I haven't seen them go up, which is fine because they've been strong. The caveat I need to make, with most of these, the numbers that I'm throwing around, the experience I'm throwing around is when you get into institutional grade properties and markets, pretty much the kind of markets that we're not seeing in Arkansas, like, primary markets, Atlanta, Austin, high growth markets. Those markets are starting to flatten. A lot of the REITs are, seeing pullbacks. They saw them before the crisis. So, but still, the performance of institutional properties, the real estate investment trusts, are still a good benchmark for the performance of the facilities in general. And the bombshell, the biggest takeaway I'd say today is this spread here, because that's what investors are looking at, is the spread. Look at the 5.13 percentage rate, the 513 basis point spread between 10-year treasuries and cap rates. And if the 5.9 cap rate seems light, keep in mind it's a institutional benchmark, larger markets, a very valid benchmark for secondary and tertiary markets, but still, it's a low cap rate loaded with, heavy management fees and stuff. So maybe, that's not to say properties haven't traded that low, in sub 6 cap rates in Arkansas. It's just, more of what we're seeing is, maybe 6 to 8 is probably more the zone, depending on how you underwrite the expenses. But again, the 513, that's what's driving a lot of the optimism, or the optimism is driving that spread, I guess I should say. And that's key, that the investment return is so strong, and that's changing the profile of investors that are getting into the storage biz. So insofar as loans that are out there, I was fortunate to have a couple closings that started during the crisis, and we just extended timelines. We didn't know what things would, how the crisis would manifest itself. So we were conservative 3 months ago, and I think we were running ahead of schedule, as far as getting everything done. We probably could have closed earlier, but, appraisers came right out. We didn't know what, how much time bankers would have to commit to new loans 3 months ago, because they were busy fielding calls on, the PPP programs, the, just basic damage control, restructuring loans. So we wanted to allow for that. I haven't tested it this week on any new transactions, or actually, I guess I am testing it. We have something that just went under contract. But as far as I can tell, banks are back on schedule and they can process loans. We may extend timelines a little bit now, but it's not anything like it was 3 months ago. I think the consensus at the last Arkansas meeting, when we all got together, was, interest rates would stay low through the election and then all bets are off. I think at this point, we're talking about at least a couple of years of interest rates staying low. If not more. The Fed has gone on record saying that rates will stay low for at least 2 years. So, we're feeling good about that. And again, that drives a lot of the positive things that are going on in our industry. Some of the other loan types, I guess, CMBS and life insurance loans are pretty much out of the market, I'm told. Fortunately, we sold a property in West Memphis in February That was funded by CMBS. That would be very problematic to do these days. It was like a $9 million sale with that sold to some apartment folks that were getting into storage. It was their second storage deal. And I shudder to think what that would be like these days to do that. Very difficult, very difficult. But that's behind us, and everything else that's on my plate is they're going to be bank loans. And conventional bank loans, I think it's safe to you could check with your local banker, but I tend to be conservative when I'm writing pro formas, so I'm thinking maybe 4% fixed for 5 years. We had a closing a couple weeks ago with a very experienced borrower. He was at 3.25%, maybe low fours, really depending on the deal and the borrower. And then the bombshell that have a closing coming up Monday where the buyer is taking care of a program that's a result of the CARES Act, and that's the program that's gotten a lot of attention. With the SBA, I believe they'll do this on 504 loans, but it's more common with SBA 7A loans, where the SBA will actually pick up principal and interest costs and loan costs for the first 6 months. So, which is a pretty heavy subsidy. The challenge is you need to get the loan needs to be issued prior to September 27th. So I think there's still time if the deal's simple enough, and this is not just storage, this is, any kind of investment property. That deadline may get extended because there's some pretty ominous news out there. But at this point, the deadline is September 27th. In the case of the transaction that I'm working on, it's a little more complicated because the buyer is funding some expansion, he's fencing, gating, and has to get city approval. So if there's those kind of roadblocks, that could kill that incentive. But it's a pretty aggressive program, and I think it's keeping a lot of the buzz going, a lot of the optimism going on. So you couple that with a low cost of capital if you just do a conventional bank loan, or and the strong fundamentals and the stability of the storage business. It's creating a really positive environment. So, one thing that's pleasantly surprising most of us, myself included, is delinquency has been surprisingly low considering all the unemployment that's out there. And we're cautiously optimistic going forward, but especially considering most of us have put off auctions, we haven't really had a need to put off auctions because the delinquency hasn't been too bad. I think I'm still sitting under 2% at our facility in Kansas City, Kansas, which historically has had there's times where our delinquency has gotten pretty bad. So we're actually doing better than we normally do. And my benchmark being this time last year, and I thought maybe last year I let things get a hand. And so I went back a couple years. I think we're seeing a bit of a drop off in occupancy, but most of us have raised rents. Some, I don't know, some of us are seeing an increase in occupancy, during these times. So the concern is, especially in, say, markets like Northwest Arkansas, where there's so much new development, so many new facilities coming out of the ground. Are those markets getting overbuilt? And of course, that's getting offset by the population growth, the job growth, in an economy like Northwest Arkansas. So so far, I have not heard that much negative about absorption in Northwest Arkansas and Central Arkansas. One of the changes that one of the concerns we've had like a year ago, which I'll start with the positive news first, is payroll seemed to be escalating faster than historic. We have seen historically, just because the job market was so tight. We think payroll is going to remain stable. Property taxes, the tax situation, we're taking all the government entities are taking on so much debt. I guess it's inevitable that we're going to be seeing increases in taxes long-term, intermediate and long-term. I don't think Arkansas is really as much at risk because you're on an investment basis, you're competing with other states and everybody's taxes will be going up. And Arkansas tends to be pretty reasonable when it comes to property taxes. Compared to neighboring states, it just seems like a lot more fair structure than, say, my home state of Kansas, which is arbitrary. I think it could cause problems just because it's not only high but also unpredictable.
Larry,
And as
Larry, if I
yeah,
might jump in here a minute, if you don't mind me
sure.
bringing this up, the board, the association board has done a few different reviews on the property tax situation into Arkansas, and it's real diverse. But from a standpoint of a buyer or seller, property taxes are passed by a vote of the public. They have to come through a popular election unless it would be a city or county that has a limit on what they can raise, and most of them are already at the limit. So it's going to take the property owners to change the property tax situation, or at least the voters, not the property owners. So if you look at the market, it still ought to be very beneficial for your clients who are looking to buy or sell anywhere almost in the state of Arkansas.
Yeah, and that goes back to my point that relative to other states, because I wouldn't take that limit for granted when you're looking at other states. In Kansas, we don't have that limit. I think it's in Arkansas, isn't it 7%, or quite often around a 7% increase is the ceiling?
Well, no, actually, I think it's 10, but that's on an appraisal. But like a city can automatically go up to 5 mills, or a county with a vote of the quorum court or the city council. But once they're there, they can't go higher than that without an election. And a school district, which is where a lot of your property millage comes from, a school district has to have a popular election in Arkansas. So, in the non-tax raising thing, if the tax base is there right now, it's going to take a lot to change that on property taxes,
Yeah.
which I think would be advantageous to.
It is advantageous, especially, coming from other states. It's not to be taken for granted that, Arkansas is really, I view it as a business-friendly state, and a reasonable amount of growth, low costs, and, like I said, that ceiling on property tax increase is not to be taken for granted. So, but thanks, Charles. I appreciate that.
Thank you.
Your perspective. And similar to in prior years, well-maintained. The ideal properties, or most sought-after properties are well-maintained, reasonably stable, and then have upside. Most buyers like some form of upside. If the rental rates haven't been changed in 5 years, and there's no rate management program in place, that just enhances the appeal, and that's fairly common. I think throughout the country, that scenario is pretty common, as there's sometimes it's due to a generational shift of self-storage owners. And then, of course, expansion potential as occupancies have been really, as they see higher occupancies. So that those are really the most sought after properties. So I would go so far as to say buyer demand right now is stronger than ever. And a year ago, I would have said there was a trend of inexperienced storage operators, say well-capitalized apartment owners or people coming from other industry types getting into the storage biz. It may just be my experience this year that I do hear from first-time storage buyers or people that like to get in the storage business that are well-capitalized and can borrow money and everything, but inexperienced with storage operations. What I'm seeing as far as properties actually going under contract, and the high bidders are usually existing storage owners, storage operators. So they know what they're doing. There's the transactions are less fickle than they were a year ago. I'm not through my closings yet, but I have a run of closings and I seem to be, Monday I'll be hitting the midpoint. I'm confident that they will all close because of that feature, that they are experienced owners. They know how to borrow. They know how to underwrite properties. And a lot of it's driven by consolidation with existing owners, and a lot of it involves automation where they're, running. I mean, it could be, one deal is they own one property in Oklahoma and they're buying a property in Kansas, which is between where they live and where they own, and they'll be putting a kiosk in. And so they're going from 1 to 2, or to go to the other extreme, Red Dot Storage has been active, and I don't even know how many properties Red Dot owns now. 100 somewhere, I don't know. My guess would be 130, 150 properties, and they're buying, and that's all automated. So we're seeing more of that, maybe not on the extent that Red Dot's doing, but in a more limited extent. And then the final slide, I kind of wanted to get into just the trend we're seeing in operations. And I remember the repercussions of the crisis 10 years ago, the financial crisis 10, 12 years ago. And it seems like, we're forced to work smarter. And, we came out, I don't think there were that many third-party management companies you could choose from 15 years ago. But 10 years ago, a lot of operators got into the management business, and they brought a level of sophistication to the industry that is positive. So right now, of course, the issues are different. A lot of it's just public safety concerns. So, we're moving a lot more towards the tools that have been out there for a while, such as touch-free leasing, automated payments, so tenants can afford, don't need to come down to the office and drop off a check. They could have done that 5 years ago, 10 years ago, perhaps probably 10 years ago. And it's forcing us to get more automated, which is safer and more efficient. And hopefully we'll have an impact on payroll. Probably we'll see more of a shift to technology, or continued shift more toward technology and maybe less from payroll. And getting away from redundant tasks such as texting for collections, which has been that was a real bombshell for us. If you're not texting, using a texting program that's integrated with your software package, I would strongly encourage you to do it, because collections, as you all know better than I do, is a redundant task that you can replace inexpensively or enhance inexpensively with a subscription to a texting program. So with that, I think I'll open this up for questions if I have any time left. Here's my contact information. I will be in the virtual meeting room with Brian, and my contact information. Hopefully you're getting our newsletters that we put out once or twice a month. If not, send me your contact information. I'll put you on our list. So, well, Shelley, do I have questions?
Yeah, I don't see any questions yet. If I may have some in my email, and if I do, I will send those over to you. Thanks for kicking off today, Larry, with some good information.
Thank you, Shelley.
It's great to be part of an industry that's thriving right now. So, all right, with that, I'm going to go ahead and quickly pass it over to Joe Doherty with